everybody, welcome to my channel and welcome for this new episode of stock analysis. Today we will be looking at Digital Turbine and the ticker is APPS, APPS. All the values that I will be presenting to you today are based on the current share price of $4.9 and all the last information that we get are extracted from the from the December 2019 conference call. So let's dive into the presentation. Just to give you, let's say, an idea of how we're going to approach the company, we will be going through the three different statements: income statement, the balance sheet, and the cash flow statement. All these values are extracted from the 10Q and the last 10K. And based on this, let's say, statement, we can extract the most valuable information and then summarize it into what I call it a DNA card. All the values summarized, then you can really have a visibility to see if you want to invest or not into this company. So let's dive in. Just quickly on the business. This company is, let's say, oriented into advertisement, but mostly by connecting app developer from mobile phone with mobile operators. So that's their main core business. They have been already dealing with more than 40 mobile operators and already, as I said, delivered more than 1 billion apps preloaded on the new phones that would be sold to new customers. Also, one important thing is that this company has been identified as the 63rd most, let's say, fastest growing company in North America as per Deloitte's Technology 500, Fast 500. So it's very interesting. Before I go into this income statement, I just want to go into this technical. I don't like too much technical charts, but it's just to give you an update, like where are we today. Over the last 3 years, the company has been into a growing channel that you can see from 2017 up to today, and a very, let's say, big compound annual growth rate. What is interesting to see is that if you really want to find an entry point to invest, it's better to go on the low side of the channel. And this is exactly where we are following the crisis. It went from $7 to almost $4. Now let's go directly into the income statement. What I show you here on this slide is the different margins, revenue and OPEX split over the last 4 quarters. In this way, you can see like what is the dynamic view of these income statements to have an idea of what is the direction that the company is going towards. So as you can see on the left, what we can see here is a steady gross margin. This is something that needs to be considered. We have an increasing revenue quarter over quarter sequentially, but year over year this represents almost 40%. So we can consider this company as a fast growing company. Okay. And also what is super important is that the company over the last quarter has been for the first time profitable. This means that they have for the first time a positive net income of 9%, which is amazing. This is due certainly to operating leverage that I will present in the next slides. But basically for a company this is a big news. Sometimes when we have like for the first time profitability, it is really a great news that might change the share price, definitely. What I looked also into the income statement is to be sure that there was no, let's say, one cash item, one-time expense or whatever that was hidden in this result, but no, it's pure net income. So that's a big plus for the company. Now let's look at the balance sheet. Same, I like to compare quarter over quarter for the last 4 quarters to give you like a dynamic vision of this balance sheet. That's why on each of the items of the balance sheet, you can see like Q1, Q2, Q3, Q4 The last one is Q4. And what I like to look at first is the long-term liability. Does the company have debt? And if yes, how much? But for Digital Turbine, actually, they don't have any debt. They even reduced the amount of debt recently from, let's say, 15 million down to 2 million. The next thing I like to look at is the cash and equivalents. What do I look at is basically if they have growing cash or not. and they went from 10 million, like also almost from 1 million to 34 million in 4 quarters. Excellent. What you need to look at also is the receivables. What I don't like is to see a company with a lot of receivables. It means that a company sometimes could be cheating or could be declaring revenue in the quarters, but actually not cashing in the money. And that's exactly what is receivables. So this is something we will need to look at in the next future to see if it's stabilized, or even if it's decreasing, it's even a better news. Then once you have this, you can calculate your total current assets. Basically, these are the sum of all these liquidity, okay, including receivable, and the total current asset is $64 million. What you want to do is with the 64 is to compare that with the current liabilities to see if they have enough, let's say, to reimburse in case of any issue. At the moment, for Digital Turbine, this current asset is more than the current liabilities. So I would say that overall the balance sheet is very sound to me. Okay. Now let's go into the cash flow statement. What you can see here on the left is all this quarterly reporting. These values are cumulative, so it means that the fiscal year for Digital Turbine ended in March, but then after it starts directly in June, September, and December, these are cumulative values. So over the last 9 months, Digital Turbine has accumulated more than $20 million in operating cash flow. Don't get me wrong, this is not directly from the net income from the company, as it has been only profitable for the last quarter, but it's definitely due to non-cash item. And one of them, actually, one of the biggest contributor to this positive operating cash flow was the change fair value in warrant liability. Okay. What you can see also here on the financing, over the last 3 quarters has been increasing, so it's a positive balance for the financing. It is due to share dilution, so warrant exercise that provide like money to the company, but on the other side it's diluting the share price, diluting the share numbers. On the last part, as you can see here, the investing section is basically capex. So overall, this year there's gonna be around $3 to $4 million of capex, because they basically invest into their software and also material. Over the last 4 years, you can see it's not really like a steady, let's say, cash flow statement. They had a lot of negative operating cash flow, at some point positive, but hopefully this year it's gonna be for the first time like a really positive and strong operating cash flow, and that will help us also to complete the acquisition that I will speak about later on the next slide. So 1+ for the operating cash flow here. I like to look also at the shares outstanding for the last 4 quarters and also for the last 4 years, just to have an idea of a feeling of how much the company is diluting shares. Over the last 4 quarters, it was only 2% share dilution. This is probably where you got like this 6 million cash from the from the financing. But overall, over the last 4 years, there was a 16% share dilution, which is like it's something like to be considered, but is not too crazy for such a growing company. So now, based on all of this information, I can summarize everything into what I call this DNA card. What I like to look first at is what is the enterprise value. Enterprise value gives us like a better idea of how much the company is worth, because you cannot only look at the market cap, it can also have like a huge debt or a huge long-term investment or big working capital. So that's why usually you take the market cap, you subtract the working capital, you add the long-term debt, and you subtract the long-term investment. This gives you an enterprise value. Then also what you want to look at is how much free cash flow the company is generating. Sometimes it's not only the earnings, because you know that there's going to be depreciation year over year. So you need to remove this depreciation into this earning. Fortunately, in the income statement, Digital Turbine is already removing this depreciation item, which gives us like the advantage of getting directly the free cash flow that is equal to the earning. And this is what the value that you have over the last 4 quarters. And if I get this free cash flow divided by the enterprise value, I get a negative return for the company. This is exactly what we want to look at, is what is the return. If I do the same exercise, but just considering the last quarter and multiply by 4 for the earning, I get a $13 million earning. Divided by the 445, which is the enterprise value, I get a positive return of 3%, which is excellent. It just gives me like an insight of what can we expect for the next year if we just base on the last quarter. And this is exactly what we want to see, a positive return. What also I like to have an idea of is how much research and development they invest, and basically they spend directly. This cannot be seen in the net income, so that's why I subtract the R&D for the net income, and then gives me a value of around 6%. All these values just be advised that they are considering the current share price of $4.9. It means that they are directly impacted by the share price. But overall, for a growing company that I will show you later here, this is a really, really good value. Now let's look at the value metrics. I like to consider to really look into what is the EV to sales. So it's the price to sales, but instead of considering the market capitalization, you consider the enterprise value. And you have at the moment an EV to sales of 3.5. What I like to compare is for a company that has, like for example, a gross margin of 40%, I want to have the equivalent of EV to sales of 4. For me, this is really a rule of thumb. 40% EV to sales of 4. A gross margin of 80% should give you maximum EV to sales of 8. This is just to have a, let's say, a gauging of where the company is it overpriced or not, just based on this gross margin. Price to cash also, I like to have it lower than 10. It shows that at least the company has a lot of available cash in hand. A price to cash of 13 is not ideal, so this is not a plus for the company, but it still have decent cash, $34 million. As I told you, the company has very low long-term debt, so that is a very big plus. They just increased the share numbers by 6% over last year. The operating revenue per employee is quite good. When it's more than $200,000 per employee per year, I consider that as a very good, efficient company, which is the case for Digital Turbine. And also what I like to look at the moment during this crisis is how much cash per employee does the company have. It gives me an idea of if there's like any rough times in the next quarters, will the company be forced to fire employees? More than $200,000 per employee, to me, looks really decent. And also, I will explain later, but the company doesn't see like any big headwind. It's not like heavy supply chain, let's say, orientated or big assets to maintain with a huge capex. So this is a good situation for Digital Turbine at the moment. Now, the more interesting part is this. I like to compare the revenue growth because this company over the last 3 years has been growing 365%. This is just amazing. This is a super fast growing company. But you want also to look at how much OPEX they grow. Sometimes the OPEX grows even more than the revenue, so it means that there's not really much of operating leverage on the company. But look, here is a perfect example of a huge operating leverage. And this is for me the big plus, the big hidden gem on this company. This is their operating leverage. Over the last 3 years, the OPEX growth has increased only by 30%. Which means that if they continue into this trajectory, the revenue increase maybe even if it's only 40%, which translates into a much bigger growth into the net income. And this is exactly what we want for a fast-growing company. Okay. So now let's look at the the few points that I extracted from the last conference call. It's super important to look at to listen to this conference call because they give you some insight of what will be the future growth and what is the direction that the company is taking. Okay. One big plus that I had recently is the acquisition of a company which is called Mobile POS. Mobile POS is evolving into the same industry, which is like digital advertising, and had a similar growth rate, let's say growth story as a Digital Turbine, because it went from 10 million revenue to 55 million revenue per year in a few years. Also, what you can see is basically the company has only recurring revenue, which is super good. They work also with big advertising companies like Google, Trade Desk, Rubicon, and they purchased this for $66 million when, with only cash transaction, when this company is gonna plan to have $55 million per year of revenue, which means that they bought the company super cheap for me, only 1 times EV to sales. The other thing that I want to, no more battery. I will just plug in. Here you go. So yes, this one EV to sales of price to sales of 1 for me, which is a really good acquisition. No dilution for the shareholders because it's only cash, so it's protecting us if we really, let's say, buy. And also what has been mentioned is like the revenue per device over the core US operators have been increasing from $2.5 per device up to $3. So it's also like showing that the company is making more and more margin on each of the devices that they are, let's say, installing their application on. Also, the company was mentioning a lot of new partners, Samsung partnership, which will be rolling on this year, with almost 200 million phones sold per year. So, which is a huge amount. If you consider like a similar type of margin for each of the of the phones, it can be a very huge opportunity for revenue growth. They mentioned about Brazil, which would become actually a strategic place in the coming years. They had also a new partner with AT&T in Mexico, which has 20 million customers. Also Telefonica and LG that have been approached. The company is also discussing with Chinese OEMs for new contracts and gets also strong demand from different brands, games, Pandora, Apple Music, Snapchat application that want to get this single tap product installed directly on their application. What is a single tap application? Is basically giving the possibility of an app developer to get its app directly installed, let's say from a page or from an application like I was mentioning here, and bypass the Google Store or Apple Store. There's a huge benefit here on these app developers because basically they can avoid to pay this 30% let's say tax on Google or on Apple. So there's a huge, let's say, market to be developed here, and this is something that's going to be source of growth for the next years. Also, the company, as I was mentioning into the income statement, has been profitable only on the last quarter, which means that they accumulated operating losses. And at the moment, the value is $86 million. And then actually, when you have net operating losses, it can give you a tax credit for the future earnings, which means that for the next year or two, the company will have no tax to pay. It means that any dollar that they make on the net income will be going into the pocket. So these are all the positive points. The only negative point, but I mean, it has to be discussed. But with this crisis, the mobile industry might be weakened. there may be less or fewer mobile phones sold, thus decreasing the revenue of Digital Turbine. However, the thing is that if, let's say, a family has some budget, has some savings, and that will not spend it on travels, or which is usually like a very big expense on the yearly basis, it might just decide to invest into, for example, communication tools, which could be also a mobile phone. Also, the 5G is going to roll out soon. If it's not 2020, it's going to be 2021. So there's going to be also like a big wave of purchasing over the next years. And with the acquisition of Mobile Post, which has a lot of recurring revenue, even though we can see a dip in the next quarters, I'm pretty sure that the revenue will still grow. So it's something securing us for the next quarters that the company will do well. So overall, that's my overall vision of this company. Just let me know what you think about it. If you have any questions, comments, or if you have another company that is similar to this growing company that you would like to get analyzed, just let me know in the comments, and I will look at them. All right, I hope you enjoyed, and thank you very much for following me until the end of this video. And then see you on the next episode. Bye bye.